Hi, my name's Eric, and I'll be reading you selections from Barron's magazine with an issue date of January 12th of 2026. This is produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We'll start with Up and Down Wall Street. 2025 was boffo for bonds. Why a repeat is unlikely in 2026, by Randall Forsyth. The bond market, whose positive returns in 2025 served as a complement to the equity market's robust gains, is unlikely to repeat that feat in 2026. If the Federal Reserve fulfills consensus expectations of 2 reductions in its short-term interest rate targets this year, the benchmark Treasury 10-year yield could actually rise rather than fall. Just a relatively small increase in the key 10-year yield would net an investor a total return no better than risk-free money markets, even with likely Fed rate cuts later in the year. More unexpected would be a sharp rise in longer-term bond yields to levels substantially above the Fed's policy rate target, a configuration frequently seen in past cycles. According to one bond veteran whose career has witnessed such episodes, supposedly safe long-term government bonds could see severe market losses of as much as 30%. A repeat of past bear routes would be the equivalent of a drop in the Dow Jones Industrial Average of over 14,000 points. To be sure, the Trump administration has been doing whatever it can to ensure the opposite outcome by trying to lower the key 10-year Treasury yield. That's one reason the U.S. benchmark was able to buck the global uptrend in bond yields last year, notes Jim Bianco, the eponym of Bianco Research Advisors. In the latest effort, President Donald Trump on Thursday ordered giant government-sponsored enterprises Fannie Mae and Freddie Mac to purchase $200 billion of mortgage-backed securities, which presumably should put downward pressure on home loan interest rates. The U.S. bond market benefited last year as mortgage and corporate bond yields declined along with Treasury yields. The Vanguard Total Bond Market Exchange-Traded Fund returned just over 7% in 2025, according to Morningstar, which accompanied the S&P 500's return of nearly 18%. But such a boffo bond showing seems unlikely in 2026, especially for longer maturities. Bianco contends the U.S. is more in sync with other developed world bond markets, given its stronger growth, higher than average inflation, and large budget deficits. We believe the trends are in place for higher long-term yields in 2026, he wrote in commentary for the Wisdom Tree Bianco Fixed Income Total Return ETF, which is managed by his firm. The 10-year Treasury yield, stuck in a recent narrow range between 4 and 4.2%, doesn't provide adequate protection from inflation, which has been around 3% for almost 6 years, add Stephen Ricciuto and Alex Pelly, Mizuho Securities USA economists. Solid economic growth and above-target inflation imply nearly 6% nominal gross domestic product growth and an eventual push to a 4.6% yield on the benchmark U.S. Treasury note, as well as a double-digit rise in bottom-up earnings for the year, they write. So these bond bears are bullish on stocks for 2026. Bond yields could move higher despite Fed rate cuts. Following the mixed employment data that was released this past Friday, the federal funds futures market looked for 2 reductions of a 0.25 percentage point for 2026, with the first not coming until June after Jerome Powell's term as Fed chair ends in May, and another in September, according to the CME FedWatch site. While the overall jobless rate dropped to 4.4% in December from 4.6% in November, non-farm payrolls increased just 50,000 in December, after downward revisions totaling 76,000 in the 2 preceding months. Even with Fed rate cuts, Evercore ISI rates strategist Stan Shipley sees the 10-year yield edging up to 4.3% from 4.18% on Friday by year-end. Just this small rise would translate into a price drop of nearly 1% in the note, which leaves investors with a total return of less than what they would earn by rolling over 3-month Treasury bills, now yielding 3.6%, even with future Fed rate cuts. Following 2025's strong bond returns, James Cochin, former fixed income strategist at Merrill Lynch and Wells Fargo, thinks 2026 could see steep declines in long-term bonds if investors fear the new Fed head will be too compliant with the administration's wishes for lower rates, he writes in an email. A cut in the Fed funds rate to 3% or lower in the absence of a recession, or a meaningful slowdown in inflation, would likely spook investors, Cochin says. He points out the difference between the current Fed funds rate, a midpoint of 3.63%, and the 30-year bond at 4.83% on Friday was about 1.2 percentage points. And that spread has been as wide as 3.5 percentage points in 1993, 3.3 points in 2002, and 3.75 points in 2010, which he saw then as a bond buying opportunity. So, a 3% Fed funds rate could coexist with a 6.75% 30-year bond. Such a backup in yields would result in a 30% price plunge. Ouch, Cochin said. Even a more modest rise in bond yields could hit stocks, as a 4.5% 10-year yield has proved problematic. In addition to monetary policy concerns, the budget deficit totaled nearly 6% of gross domestic product in the past fiscal year, even with the addition of tariff revenue. A Supreme Court decision on the legality of those levies is expected soon. What the already tumultuous events of the new year show is that nothing should be unexpected. On to the Streetwise column, written by Jack Huff, titled 4 Theories About a Beer Maker's Falling Stock Price. Are immigration raids hurting Mexican beer sales? The question might sound both indelicate and frivolous at a time when Americans are hotly divided over the tactics of ICE. But on Wall Street, it's at the center of a debate on whether to buy the beaten-down shares of Constellation Brands, owner of Corona and Modelo. More than half of Constellation's beer customers are Hispanic. The company had long bucked an industry slump with splashy growth, but lately it's been slipping. Shares fell by a third for the year leading up to this past Thursday's quarterly earnings report. On the call, an analyst asked CEO Bill Newlands squarely about something the company had mostly only alluded to. If the Trump administration launched high-profile immigration raids about a year ago, shortly after Inauguration Day, and if those raids have made some Hispanic consumers pull back on social gatherings where beer is enjoyed, then once we lap that initial shock, is it possible that it just gets a little bit less bad? In other words, might easier sales comparisons return Constellation to growth? And Newland's response? We hope you're correct. That would be a lovely outcome. And he offered a new piece of evidence. Barclays, however, is skeptical. More on all of that in a moment. For investors who wonder why a company from New York's Finger Lakes region sells Mexico's best-known beer, some quick history. In 1945, Marvin Sands, the son of a Queens, New York vintner, took over a sauerkraut factory turned bulk winery in Canandaigua, a half-hour drive from Rochester. He needed a hit brand to squeeze higher profits from his grapes. King Solomon kosher wine failed to take off, but Richard's Wild Irish Rose, a cheap, sweet, and effective screw-cap affair named for Marvin's son, minted money. Decades later, Richard and his brother led Constellation into premium spirits and wines and would eventually dump Rosie and other cheap bottles. In 2013, Constellation struck gold a second time, in beer of all things, when Budweiser parent Anheuser-Busch InBev bought Grupo Modelo. It had to sell U.S. rights to Corona, Modelo, and the company's other brands as part of an antitrust agreement. Constellation's limited beer exposure made it a safe buyer. The Corona brand at the time was a rare combination of iconic and woefully undermarketed, which was easy for Constellation to fix. Its innovations included putting the stuff in cans. A fast-growing U.S. Hispanic population added to growth, and 2 years ago, amid a Bud Light boycott, Modelo became America's best-selling beer. An investor who held Constellation stock over the decade through 2022 made 22% a year, versus 13% for the S&P 500, 4% for Molson Coors Beverage, and a 2% yearly loss for Anheuser. So what went wrong? Theory number one is that Constellation has simply tapped its growth opportunity with Modelo and now looks more like other big brewers. On Thursday, the company reported fiscal third quarter results with depletions, quote unquote, an industry term for brewer shipments down 4% for Modelo and 9% for Corona. This was partially offset by smaller brands Pacifico and Victoria, which are growing nicely, but depletions for the whole beer category fell 2.2%. Management noted that its beer still has 20% less distribution than that of industry heavyweights. That doesn't sound like a company that's run out of room for growth. Theory number two is that the stock was simply priced for perfection and perfection ended. Shares routinely went for 22 to 23 times earnings leading up to 2 years ago, while other big brewers often traded at price-to-earnings multiples in single digits. And now the stock is down below 13 times earnings. In recent years, it's fallen on earnings day more often than not, but this past Thursday it gained 5%. Wall Street called the results good enough, considering that the case for shares rests on a future return to normal conditions, with maybe a little help from the World Cup of Soccer this summer, which will be co-hosted by the U.S., Canada, and Mexico. Theory number three is that Hispanic customers are buying less beer because of economic concerns. And theory number four is that they're doing so because of immigration fears. Now, these are difficult to disentangle. Back in April of 2025, CEO Newlands cited company research showing that 2/3 of its Hispanic customers were concerned about higher prices for food, gas, and other essentials, and half about immigration issues. He also mentioned concerns about job losses in industries that have a high Latino employment base. These were leading to declines in efforts to go to restaurants, to have social gatherings, things that are very much beer occasions. Since then, Constellation Management has kept most of its commentary on what's ailing its Hispanic customers to blanket mentions of socioeconomic concerns, which makes Thursday's comments on lapping immigration raids interesting, if not fully illuminating. If the raids have cut into beer sales, and the effect has already been fully felt, then Constellation might be headed for better sales and stock performance soon. Newlands on Thursday offered this clue. The company has seen improving beer demand in zip codes that are less than 20% Hispanic, but ones that are over 20% remain very challenging. For now, Wall Street's predicting a 16% decline in Constellation's earnings per share for its fiscal year through February, followed by a 7% rebound next year. But next year's estimate has been sliding in recent months. Barclays writes that it has noticed rising optimism on Constellation stock focused on the immigration raid thesis, but it calls that a trading idea, not a long-term reason to hold the stock. We could understand there being limited risk of additional headwinds from reduced social behavior beyond what's already transpired, it writes. But we think it remains to be seen what lapping does or doesn't mean for the category at large. Looking at what happened last week and what's to happen This week is the review and preview section of Barron's, dated January 12th. Bullish on 2026 IPOs. After a lackluster 2024, initial public offerings roared back to life in 2025. IPO research and investment manager Renaissance Capital says 202 companies priced IPOs in 2025. That's a 35% increase from 2024, raising some $44 billion, up almost 50% from 2024. And that came in the face of tariff-related volatility and a government shutdown. IPO watchers see even better times in 2026. Now, with more stable ground underfoot and a backlog brimming with the next wave of innovators, we're optimistic that the IPO market will resume its long-awaited pickup in 2026, Renaissance analysts say. The firm estimates that 200 to 230 companies could go public this year, potentially raising $40 to $60 billion. To that end, a pack of large private startups, so-called unicorns, hungry for capital may line up to go public. Elon Musk's SpaceX could be the largest IPO ever, seeking to raise $30 billion, topping Saudi Aramco's $29 billion IPO in 2019. And then there's artificial intelligence startups such as Anthropic, OpenAI, Databricks, and Musk's xAI. Equity Zen, which runs a platform to trade shares of private companies, notes that AI firms Cerebras, Cohesity, and Lambda Labs may seek IPOs, as could crypto firms BitGo, Consensus, and Kraken. Of course, the health of the IPO market is tied to the broader stock market. As long as the bulls run, expect more unicorns to join the parade. And if stocks stumble, all bets are off. That was written by Paul R. LaMonica. Last week, in markets, the week began with investors unclear about U.S. plans for Venezuela after the capture of President Nicolas Maduro and his wife. Oil, gold, and silver were volatile. The dollar and oil-related shares rose. President Donald Trump talked of the U.S. seizing Greenland. Still, the Dow Industrials set consecutive highs before indexes sank on Wednesday. The U.S. added 50,000 jobs in December. On the week, the Dow rose 2.3%, the S&P 500 1.6%, and the Nasdaq Composite 1.9%. In companies, Venezuela surrendered up to 50 million barrels of sanctioned oil to the U.S. Oil majors expressed caution over investing in Venezuela without U.S. guarantees. And defense stocks sank after Trump threatened to cut RTX's Pentagon contracts, and then rose when he proposed raising the defense budget by 50%. Trump also said he would ban private equity from home buying and told Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds. NVIDIA announced a partnership on autonomous driving with Mercedes-Benz. Advanced Micro Devices introduced a new AI chip. Deals Glencore and Rio Tinto resumed merger talks. Australia's BlueScope Steel rejected an $8.8 billion bid from Steel Dynamics and SGH. The Financial Times reported that Chevron and Quantum Capital will seek to buy the international assets of Russian oil company Lukoil. Power generator Vistra agreed to buy Cogentrix Energy for $4 billion, including debt. And Warner Brothers Discovery rejected Paramount Skydance again. What's scheduled for this week? On Tuesday, January 13th, fourth quarter earnings season kicks off with the big banks reporting their results. Bank of New York Mellon and J.P. Morgan Chase release their earnings on Tuesday, followed by Bank of America, Citigroup, and Wells Fargo on Wednesday. BlackRock, Goldman Sachs Group, and Morgan Stanley announced their results Thursday, while PNC Financial Services Group and State Street close out the week on Friday. The Bureau of Labor Statistics releases the Consumer Price Index for December on Tuesday. Consensus estimate is for a 2.7% year-over-year increase, even with November's figure. The core CPI, which excludes volatile food and energy, is expected to also rise 2.7%, 1/10 of a percentage point more than previously. On Wednesday, January 14th, the Census Bureau reports retail sales for November. The consensus call is for a 0.4% of a percent increase month over month, following a flat reading in October. Excluding autos, retail sales are seen rising 0.3%, 1/10 of a percentage point less than previously. And the National Association of Realtors reports existing home sales for December on Wednesday. Economists forecast a seasonally adjusted annual rate of 4.23 million homes sold, 100,000 more than in November. By the numbers, $38 billion. That's the amount spent by U.S. money managers on M&A deals in 2025, double that of 2024. 65,000, the estimate of how many industrial jobs the U.S. lost in 2025, a reversal from 2024's addition of 250,000. 15.8 million, Cox Automotive projection of new cars sold in the U.S. in 2026, down from 16.3 million in 2025. And 255, the number of activist campaigns worldwide in 2025. That's up about 5% from 2024. U.S. campaigns rose 23%. The next article, why Latin America's future looks bright. U.S. intervention in Venezuela shouldn't deter investors from a number of promising opportunities in a region where stocks rose 46% last year. By Reshma Kapadia. The turmoil unfolding across Latin America in the aftermath of the U.S. seizure of Venezuelan leader Nicolas Maduro might not look terribly inviting for investors. But those who take a longer look will find a lot to like across the region, starting with the fact that Latin American stocks rose 46% last year, and more gains could be ahead. Latin America is in the middle of a right-wing political wave, ushering in business-friendly leaders promising deregulation and other market-friendly reforms. Commodities such as precious and base metals are seeing strong demand as the world embraces artificial intelligence and electrification, and as central banks and investors diversify holdings with gold and silver. J.P. Morgan strategists expect that the MSCI EM Latin America index could rise as much as 30% to 3,500 by year-end. Latin American stocks could be just the ticket for investors whose portfolios have grown too U.S.-heavy after years of explosive tech growth. Latin American stocks account for just 7.3% of the broader MSCI Emerging Markets Index. It's an indication of how off the radar they are for most investors. Renewed interest could extend recent rallies. Consider, foreign investors now own 17% of U.S. assets. Were they to reallocate just a percentage point of those holdings into emerging markets, that would result in a $50 billion inflow into Brazilian stocks, one of the region's largest markets. That's 10 times last year's inflows, says Scott Piper, manager of the DWS Latin America Equity Fund. Latin American stocks are trading at about 9 times forward earnings, below their 10-year average of 11.1, and poised for policies in the region to go from bad to less bad. The region has been economically mismanaged over the last 5 years because we've had extreme populism across the board, fiscal largesse focused on handouts, and in many cases financed with higher regulation, higher taxes with a more statist approach, Piper says. But Piper senses a discernible trend toward center-right candidates. Jose Antonio Cast recently won election in Chile on a Trump-like anti-immigrant and anti-crime platform, and by vowing business-friendly reforms. Others will follow in his wake elsewhere in Latin America. Part of the right's success, Piper says, lies in voters' growing concern about crime and corruption after a rise in crime under left-leaning administrations. As a result, the right could do well when voters go to the polls in Colombia in March, Peru in April, and even possibly Brazil in October. Government turnover can be especially potent for emerging market investors. It's the improvement in policy, specifically changes in economic freedom, that tends to drive stock outperformance in emerging markets, says Patrick Campbell, a fund manager at Morgan Stanley Investment Management, focusing on Latin America. Policy changes such as a deregulation push in Chile, increased focus on security, and a reining in of spending could mean more attention to fiscal concerns and lead to long-lasting economic growth. President Donald Trump could be a spoiler. He's pushing to reassert dominance in the Western Hemisphere. His version of the 1823 Monroe Doctrine allows for military and economic coercion and intervention to protect commerce, territory, and resources core to U.S. national security. But there could also be opportunities, not just for the leaders aligned with Trump, but also for those who control resources that the U.S. and its geopolitical rival China are now clamoring for. Latin America mines almost half of the world's copper, much of it in Chile and Peru, and is home to 60% of global lithium reserves. Brazil boasts the third largest reserve of nickel and rare earth elements. The U.S. and China both view the region's infrastructure, ports, telecommunications, and energy as strategically important. China is the biggest exporter to South America. China has stakes, operations, or ties in the 39 ports in Latin America and the Caribbean, according to the Center for Strategic and International Studies. Similar to how the U.S. in recent weeks outlined its reasons why Latin America is a national security priority. China released a policy paper in early December outlining its blueprint for expanding its footprint in the region. The geopolitical backdrop in Latin America could benefit investors. U.S.-aligned leaders will see their policies backstopped, while the likes of Brazil have assets both sides want. The Trump administration showed how far it will go to support its allies with a $20 billion financial assistance package for Argentina in October. One measure of the country's sovereign risk fell to a 7-year low. Meanwhile, Latin America is poised to benefit from a new global commodity boom that has created attractive imbalances for the region between supply and demand. Copper prices rose sharply last year, and analysts expect that to continue. There isn't enough global copper production to meet demand, in part because 3 of the top 20 copper mine projects globally are on hold or shut down, says Andrew Keeler, an emerging markets investment specialist at Bailey Gifford. Lithium is also in shortage. The 100 or so mines around the world can't produce enough to meet the demand for electric vehicles, he says. A lot of big investors have missed the Latin America trade, says Todd McClone, a manager for William Blair's Emerging Markets Strategies. Hedge funds have hired too many tech analysts and too few commodity experts. They're underweight for the wrong reasons. Latin America lacks big AI plays, but its commodities companies stand to gain if AI spending forecasts are realized. That could be the real kicker, says Keeler, noting that Latin America is well placed to benefit from increased energy demand to power AI and its data centers. Interest rates are falling too, raising the potential for greater economic growth. A dozen straight rate cuts in Mexico have brought its interest rate to 7%. That's the lowest level in more than 3 years. Chile has cut as well. Brazilian central bankers aren't yet on board. Even though inflation in Brazil has fallen from 12% to 4.5% over the past 3 years, interest rates have remained stubbornly high at some 15%. But investors widely anticipate the first rate cut either this month or in March, and that would give Brazil's heavy dose of rate-sensitive stocks a boost. We spoke with money managers and investment strategists to get a view of how these changes could create opportunities in three of the bigger, more accessible markets for investors: Chile, Mexico, and Brazil, and found four funds for investors to get quick access. In Chile, the MSCI Chile index rose 74% last year, largely in anticipation of a win by the market-friendly Cast. He won by a landslide on December 14th and takes office on March 11th. Morgan Stanley's Campbell sees stock gains ahead as the new president cuts corporate taxes and speeds up mining and construction permits. Commodities are also powering optimism. Chile is home to the world's largest copper reserves at about a fifth of global reserves and the biggest lithium reserves, accounting for a third of global supply. Derek Irwin, co-head of the Intrinsic Emerging Markets Equity Team at Allspring Global Investments, favors lithium producer SQM, as well Falabella, a Chilean retailer with strong free cash flow that's positioned to benefit from an improving economic backdrop. Brazil. Fund managers expect a lift for stocks once Banco de Brasil finally starts cutting rates sometime in the next few months. Roughly 60% of Brazil's corporate debt is variable, so a rate cut would offer companies a quick reprieve, Keeler says. Brazilian stock exchange operator B3SA Brasil Bolsa Balcão could also benefit from lower rates that would nudge Brazilian investors out of bonds and into equities. Keeler also owns Axia Energia, which generates a quarter of Brazil's electricity. DWS's Piper favors Brazilian utilities, real estate, and logistics companies, as well as financials that are more sensitive to interest rate changes. He believes that lower rates could power years of gains. Politics, however, could intervene. The vote for president in October is likely to bring big swings regardless of who wins. The right isn't necessarily favored in Brazil, unlike elsewhere in Latin America. Left-wing President Luiz Inácio Lula da Silva is running for re-election against divided opposition. Former President Jair Bolsonaro surprised investors who had expected him to endorse center-right São Paulo Governor Tarcísio de Freitas. Instead, the far-right Bolsonaro backed his son, Senator Flávio Bolsonaro. The elder Bolsonaro is in prison for plotting a coup, and his decision leaves the right split. It's still early. Freitas could still decide to run, prompting a stiffer challenge to Lula, whose term has been marked by hefty government spending that's intensified concerns about Brazil's fiscal health, and a probe into a $1 billion pension fraud and messy budget fights. If Lula were to lose, Brazilian assets would re-rate 50%, Piper says. And finally, Mexico. Investors see less of a broad-based opportunity in Mexico, where stocks aren't as cheap as elsewhere given the growth prospects. The Trump administration plans to renegotiate the U.S.-Mexico-Canada trade agreement that was struck during the first Trump term. Questions about the deal could weaken company outlooks. Trump has also threatened to use the U.S. military against Mexican cartels, a move that would rattle markets. Still, President Claudia Sheinbaum gets high praise from geopolitical analysts for deftly forming a strong relationship with Trump. Sheinbaum imposed tariffs on China amid U.S. complaints that the world's second-largest economy is using Mexico to get around U.S. tariffs. That move also helps Mexico avoid becoming a dumping ground for cheap Chinese goods. Sheinbaum also put 10,000 National Guard troops at the border to do more to curb drug flows. Mexicans would probably react badly to any direct U.S. intervention. Mexico lost more than half of its territory in the U.S.-Mexico War during the 19th century. Sheinbaum has been very clear. Yes, there will be cooperation, but no unilateral action and no boots on the ground. That really is a bright red line for Mexico, and for the U.S. to cross it would set back the U.S.-Mexico relationship for a generation, says Christopher Hernandez-Roy, Deputy Director of the Americas Program at the Center for Strategic and International Studies. If Mexico emerges from USMCA talks with a favorable renegotiated deal, it will spur investment, especially into manufacturing and industrials. But for now, fund managers like McClone are taking a more selective approach. He holds silver miner Industrias Penoles, while Bailey Gifford's Keeler owns Fomento Económico Mexicano, or FEMSA, which operates a Coca-Cola bottler and has turned around its OXXO convenience stores. Investors looking for a more diversified way of getting access to Latin American stocks may want to veer away from typical emerging market funds, which have only 11% in the region. Two outliers, the Brandes Emerging Markets Fund, Market Value Fund, has 26% of its assets invested in Latin America and has outperformed 95% of its peers with an annual average return of 10% over the past 5 years, while the Lazard Emerging Markets Equity Portfolio holds a fifth of assets in the region and has beaten 96% of its peers over the past 5 years with an average return of almost 11%, according to Morningstar Direct. A cheap, plain vanilla option, the iShares Latin America 40 exchange-traded fund, provides exposure to some of the biggest companies in the region. And for a slightly different approach, the Freedom 100 Emerging Markets ETF weighs countries based on dozens of indicators of personal and economic freedoms, including strength of institutions, rule of law, and size of government. The fund has a 19% allocation to Chile, 6.5% to Brazil, and 1.5% in Mexico. The next headline, gold and silver surged, crypto sunk. Miner stocks did especially well in the fourth quarter, while crypto funds took a dive. One big surprise, the sudden resurgence of healthcare, by Louis Brahm. Despite some bumps along the road, 2025 was a solid year for stock and bond funds, as was its final quarter. For cryptocurrency funds, though, the quarter was a textbook illustration of the dangers of too much leverage. A sell-off in October, triggered by a sudden escalation of the trade war with China, caused crypto funds to crash due to record levels of borrowing applied by crypto traders to the sector. That triggered forced selling from margin calls by brokers, driving down security prices for even unlevered investors who suffered collateral damage. The average fund in Morningstar's digital assets category nosedived 19.2% in the fourth quarter, making it the second worst performing category behind equity digital assets investing in crypto-related stocks, such as Coinbase Global, which were down 19.8%. The largest digital asset fund, the $67 billion iShares Bitcoin Trust exchange-traded fund, fell 23.5% in the quarter and lost 7.1% in 2025. It was the opposite case for gold bullion and gold miner stock funds. The $147 billion SPDR Gold Shares ETF gained 12.5% last quarter and surged 64.4% for the year. But that pales in comparison to funds in Morningstar's equity precious metals category, as miner stocks have a leveraged relationship to the price of bullion. The $26 billion VanEck Gold Miners ETF was up 13.5% in the quarter and a surreal 155.6% for the year. That's slightly behind the category's average 18.3% quarterly and 161.7% 2025 returns, making it, by the far, the year's best performing fund category. Can the good times continue for such a narrow, volatile sector? Probably not, as sector leadership often switches from year to year. Those expecting the silly 795% 2025 returns of the year's best performer, the leveraged $2.1 billion microsector's gold miners 3x leveraged, to repeat, are almost surely fooling themselves. A small position in a gold bullion fund such as SPDR Gold shares, while pricey now, can serve as a ballast in uncertain times, as long as one doesn't treat it as a speculative, short-term investment. One should also avoid short-term speculation, even with portfolio mainstays, like the $1.5 trillion Vanguard S&P 500, which was up a solid 2.7% for the quarter and 17.8% in 2025. The index ETF has a trailing 12-month price-to-earnings ratio of 27.6, according to Morningstar Direct, when historically its average is 16. In the past 3 years, the ETF's 23% annualized return is more than double its long-term average return of 11%. The good times can't last forever, yet a low-cost index fund is a great choice for patient investors who are willing to ride out the bad. Not that such a strategy fully explains the surge of money into S&P 500 products. Once again, the Vanguard S&P ETF had the biggest inflows by a wide margin, some $40.9 billion for the first 2 months of the quarter through November 30th and $125 billion for 2025 to date. December flow numbers aren't yet available. More interesting right now are international stock funds. Vanguard Total International Stock had the largest inflows for foreign funds, but at $4.5 billion, it's small potatoes when it's compared with Vanguard's S&P 500 ETF. That's despite the fact the fund beat the S&P 500 both last quarter, returning 4.5%, and in 2025 with 32.2%. It has a trailing profit-to-earnings ratio of 17.1, retaining a sizable valuation discount to U.S. large-cap stocks. The valuation gap and return potential should be even greater with a tilt toward value stocks. The foreign large value fund category was the fifth best performing category last quarter, up 6.5%, and the only diversified non-sector specific category in the top 5. On the ETF side, iShares International Select Dividend and GMO International Value were each up over 9% for the quarter and over 45% in 2025. Each still has a cheap trailing P/E ratio of about 12, less than half the S&P 500. Mutual funds Europac International Dividend Income and DWS Croce International were also strong. Perhaps the biggest surprise in the quarter was the sudden resurgence of healthcare stock funds, with the average fund in Morningstar's health fund category up 13.3%. This marks a sharp reversal for the long problematic growth sector, especially when compared with the more beloved tech fund sector, which was up 22.8% for the year, but only 0.4% in the quarter. A number of experts have speculated on the reasons for the sector rotation to healthcare, but haven't come up with a definitive answer. One cause could be artificial intelligence fatigue, while healthcare stocks remain relatively cheap. Another could be a spate of acquisitions in the sector, while a third could be the promise of more blockbuster weight loss drugs. The prospect of declining interest rates can also help biotech companies, as they depend heavily on debt to finance their drug research and development. Finally, the current political administration seems to have eased up on drug makers regarding tariffs and drug prices. Investors continued to turn from active to passive management and from mutual funds to ETFs. Through November 30th, investors pulled some $457 billion from active U.S. equity mutual funds, $110 billion of that just in the first 2 months of the fourth quarter. Yet the quarter saw a net $185 billion of inflows into active funds overall because of the increasingly popularity of active ETFs and active bond funds, $19 billion into the former and $24 billion into the latter. Meanwhile, billions keep flying out of excellent mutual funds like Vanguard Prime Cap, which lost $16.1 billion in asset flows in 2025, but beat 98% of its large blend category peers with a 29.9% return. Yet the fund distributed over $27 per share in taxable capital gains in 2025 and over $9 in 2024. Investors seeking tax efficiency are better off with ETFs. Some marquee fund managers have held out from launching ETFs, but their numbers are shrinking. In November, Vanguard rolled out the Vanguard Wellington Divided Growth Active ETF, which has the same Wellington management manager, Peter Fisher, as the $44 billion Vanguard Dividend Growth Fund. The mutual fund distributed almost $5 a share in taxable capital gains in December and saw almost $10 billion in outflows in 2025. The ETF holdouts will probably cave soon. Our next article in Barron's of January 12th, 2026. 3 defensive dividend ETFs to soften a potential stock market downturn, by Lawrence C. Strauss. After 3 straight years of double-digit returns for the S&P 500, dividend investors should consider some ways to give their portfolios more downside protection. One possibility is to hold one or several defensive-focused dividend exchange-traded funds. Dan Soderoff, a senior analyst at Morningstar, says that it's a good time of the year for investors to look at their portfolios and reassess their allocations, especially after a massive run-up in the stock market. There's certainly plenty to be concerned about as 2026 begins, including weaker job growth and pricey stock valuations. No way to sugarcoat it, the S&P 500 is expensive, B of A Securities wrote in a December 31st research note. While the bank's analysts do see some pockets of opportunity, they're less enthusiastic than most, with a year-end target of 7,100 for the S&P 500. That would amount to a roughly 2% price increase for the index this year based on recent levels. What's more, 2025 marked the 3rd straight year of double-digit gains for the S&P 500. A 4th consecutive year of these results isn't guaranteed. Far from it. Of course, more defensive dividend ETFs aren't always a panacea in a down market. While dividend ETFs would certainly cushion the blow, bear markets have a way of taking no prisoners, says Paul Hickey, co-founder of Bespoke Investment Group. He points out that in 2022, the last year in which stock indexes saw significant price declines, most dividend ETFs slid, but not as much as the overall market did. Dividends no doubt helped cushion some of the blow. The S&P 500 returned minus 18% that year, including dividends. Based on prices alone, the index was down 19.4%. One dividend fund with some notable defensive traits is the $73 billion Schwab U.S. Dividend Equity ETF. The index the fund tracks attempts to weed out highly volatile stocks and favors companies with fundamental financial strength, including healthy balance sheets. Those two things in combination give the fund a defensive characteristic or risk-reward profile, says Soderoff. The ETF, which is weighted by market capitalization, tries to track the Dow Jones U.S. Dividend 100 Index. Constituents of that index have paid a dividend for at least 10 straight years and are deemed to have the financial wherewithal to continue doing that. Top sector weightings as of September 30th were energy, consumer staples, healthcare, and industrials. Stocks included drug maker AbbVie, which yields 3.1%, defense and aerospace company Lockheed Martin, 2.7%, tech giant Cisco Systems, 2.2%, and telecommunications company Verizon Communications, 6.9%. The fund returned minus 3.2% in 2022, still about 15 percentage points ahead of the S&P 500. It returned 4.6% the following year, and 11.7% and 4.3% in 2024 and 2025, respectively. Last year's performance lagged behind the S&P 500's nearly 18% total return, but the fund can provide some downside protection. It yields an attractive 3.8%. Another option to consider for a down market is the $120 billion Vanguard Dividend Appreciation ETF. It aims to mimic the S&P U.S. Dividend Growers Index, whose members have grown their dividends for at least 10 straight years. The index differs from the Dow Jones Index in that it excludes the top 25% highest-yielding companies that meet that criterion. The rationale? Higher-yielding companies can be risky in terms of maintaining their payouts and facing eventual dividend cuts. The fund tends to hold stocks that have stronger fundamentals, Soderoff says. Its 1.6% yield isn't anything to crow about, but it still beats the S&P 500's 1.1%, and with around 340 holdings, the ETF does offer some diversification. Another way it provides some protection in a down market. These dividend ETFs that are more defensive are a little bit safer, he says. They're taking risk off the table. They're usually giving up yield because they're in safer companies. Top sector weightings include information technology, nearly 28%, financials, 21.4%, and healthcare, 16.7%. Holdings include Apple, which yields 0.4%, J.P. Morgan Chase, 1.8%, and ExxonMobil, 3.3%. There's also the $27 billion Capital Group Dividend Value ETF. It's actively managed, meaning the managers pick stocks rather than track an index. It's managed in a more conservative way, says Soderoff. It's not going to have the highest yield, but it's built around paying dividends. The fund recently yielded 1.4%, below the yields offered by the other two funds mentioned above. It returned nearly 29% in 2023, its first full calendar year of existence, about 20% in 2024, and around 25.5% last year. Top holdings as of November 30th include pharmaceutical company Eli Lilly, which yields 0.7%, Microsoft 0.8%, and semiconductor company Broadcom 0.8%. Stocks with higher yields held by that ETF include British American Tobacco at 5.9% and Starbucks at 2.9%. Its largest sector weighting as of November 30th was information technology at a little more than 25%, followed by industrials 15.6% and healthcare 14.1%. Bespoke's Hickey points out that if the market did sell off sharply owing to concerns about equity valuations, richly priced stocks would do the worst while value stocks would hold up better. In that type of environment, it's usually higher yielding dividend stocks that hold up the best, he says. And with that in mind, a more defensive dividend ETF certainly makes sense as a hedge given the uncertainty for stocks this year. In our final column, the International Trader, Investors Are Glum Over Japan's Prime Minister by Craig Mello. U.S. voters aren't the only ones up in arms about affordability. Japan has cast off lost decades of deflation to join the rest of the developed world in modest inflation, currently running near 3%. It's been good for stocks as companies recovered long-lost pricing power and banks could earn net interest margin. Ordinary Japanese worry about their incomes keeping pace. Real disposable income has hovered around zero in recent years, says Shigeto Nagai, head of Japan economics at Oxford Economics. That angst was a big reason why 64-year-old Sanae Takaichi surged from dark horse to Japan's first female prime minister in October. She has flipped the script with strategically targeted spending hikes and tax cuts, plus some tough talk toward China. Her approval ratings are near 70%, while investors turn glum. The iShares MSCI Japan Exchange-Traded Fund is flat since Takaichi became Liberal Democratic Party leader on October 4th. It soared more than 20% over the previous 9 months. The Japanese market looks fully valued, said Alex Wolf, global head of macro and fixed income strategy at JP Morgan Private Bank. We are neutral. The fixed income front is more alarming. Yields on 10-year Japanese sovereign bonds have climbed nearly half a percentage point to 2.12% on Takaichi's watch. The yen, which should be in theory rising with higher bond returns, has lost 6% against the dollar. The yen is stuck below its long-range fair value, says Aaron Hurd, senior currency portfolio manager at State Street Global Advisors. I don't see a catalyst for a rally except some big global risk-off event. Investors felt relaxed about Japan's world-leading government debt, well over 200% of gross domestic product, so long as it paid no interest on it. If rates keep climbing, the fiscal noose might tighten. Japan is one of the leading candidates in the world for a debt shock, Nagai warns. No one's pushing a panic button just yet, though. Unlike the UK, where so-called bond vigilantes forced Prime Minister Liz Truss out of office after 7 weeks in 2022, Japan is a massive creditor nation, with net foreign assets of $3.7 trillion, according to Kyodo News. In extremis, domestic investors can repatriate capital to cover Japan's debt, says Nick Verdi, a global rates and FX strategist at TCW. Takaichi's fiscal splurge has been as much hoopla as substance, with crowd-pleasing measures like increasing income tax deductions and abolishing a gasoline tax. Higher inflation-driven revenue may keep debt to GDP stable. Bond issuance hasn't increased in her first 100 days. Wages are looking up, with unions demanding a 5% hike in spring negotiations that set the bar for everyone else. Federal Reserve cuts and further inching upward by the Bank of Japan should reduce the interest rate gap, pulling Japanese capital back home and bolstering the yen. And with that, we've come to the end of our reading of Barron's Magazine for January 12th of 2026. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.